I thought, why not start with a very good quote that probably would have seemed very appealing a year back, but does not make a lot of sense today to a lot of us sitting here. Equity is for wealth creation, debt is for wealth protection. Neither does equity, neither does debt give you the same confidence that the quote probably talks about. So what went wrong? So the first thing that came up was the IL&FS case. IL&FS, like all of you all know, is a massive infrastructure company, and you suddenly saw that it got boomed, and there was a default. So what went wrong? So ideally, it is said that what happened in IL&FS case is ALM, asset liability mismatch. What does that mean? So let's say if IL&FS gets a 10-year road project to be made, IL&FS would have to borrow some cash for 10 years to build the project, and then assuming that the project will make monies and that monies will be paid back. So when a 10-year zero coupon bond is raised, zero coupon because IL&FS does not want to pay monies at the interim, but want to pay everything at the back. So IL&FS will raise 10-year zero coupon bond from the market, but at the end of the 9th year, IL&FS will generally understand that this project will not get completed on time and I will need some 3, 4, 5 more years. Now at the 9th year, IL&FS knows that though the project is going to take 5 more years for me to get done with, I have to pay 1 साल के बाद जब 10 साल वाला bond mature होगा. Now at the 9th year, if IL&FS goes out and tries to raise money for another 5 years, nobody will give money. So what IL&FS does is borrows a 1-year loan so that they can pay off the maturing loan at the next year. Now what they have done is they borrowed a very small term loan to pay off for a larger term project. Now that is where asset liability mismatch happens. I clearly remember it was April 2018 when one of the largest entities of IL&FS, which is IL&FS Transportation Network, which has some 38,000 odd crore worth of loans outstanding, could not make a payment on April 2018. So though IL&FS network, transportation network quoted that actually to be a technical error, a lot of lenders already understood that probably something is going wrong and they would not want to make this liquidity very easy for IL&FS. Is where the liquidity crunch started at IL&FS. Rollover stopped, right? So the newer loan that they were taking to pay the older loan stopped, and boom, is where you saw IL&FS default. What happened post that was DHFL case. Now DHFL, according to me, is actually a fallout of the IL&FS case. What happened in DHFL? DHFL is the 3rd largest housing finance company in India today, managing close to 1 lakh crore worth of assets today. When a AAA rated debt like IL&FS defaulted, everybody panicked in the market. Nobody was really very confident to lend more money to even somebody who was AAA, and is where liquidity started freezing for DHFL at a very fast pace. I very clearly remember it was DSP BlackRock who probably came out and sold some 300 crore worth of debt of a AAA rated IL&FS at 10.5%, 11% yield, sending panic signal to the market that something is going wrong in the DHFL story. The stock crashed, and you today see that probably DHFL finds it the most difficult to raise more money from the market. Now imagine a housing finance company whose business is to borrow from the market and to lend. If liquidity freezes for such a company, what would be the situation? And that's exactly what has happened at DHFL. Then all of us heard of a new story, which was SL. Now what happened at SL Group was something called as loan against shares. For people who track the markets, which all of us does, we would know Zee Entertainment and Media is, for all practical purposes, a zero debt company. But promoters were excited to enter into various other businesses like infrastructure, D2H, they bought over Videocon and stuff. The way they financed this new acquisition or newer businesses was loan against shares. Now how does that happen? Very simple. Suppose the loan against share ratio is 2, which means if you give 100 rupees of shares, you get 50 rupees of debt. And that 50 rupees of debt is used to either invest in infrastructure companies or buy new businesses. Now, as and when you start buying newer and newer businesses, your stock price would go up, assuming that you will do great in the future. The same 100 rupee of stock became 500 rupees. which means for the same 100 rupee of stock where I could borrow 50 rupees of debt in the past, now the same 500 rupee share got me 250 rupees worth of borrowing. So for that 500 rupee worth of stock, I bought 250 rupees worth of debt and invested in the company. Like everybody knows, neither did the infrastructure company pick up, nor did the Videocon D2H thing really picked up for them. Market started realizing and the stock price started correcting. Now when the same 500 rupee worth of stock became 200, you are allowed to only raise 100 rupees of debt, but you've already raised 250. Now what happens is for the remaining 150 rupees, you have to give extra cash or shares, is where the Zee promoters said that I will not give extra cash nor shares, is where you saw that lenders came out in the market and started selling the shares because they did not keep up to the ratio that they had spoken about. But what happened was just 1.3% of Zee shares which came out to the market to be sold, the stock tanked 30%. By the way, 20% of Zee shares are pledged. Now this is what all of us are aware and have been seeing in the debt market or what's been happening for the last 1 year. Now there are 4 things that I want to leave everybody here with, and extremely important according to me for a financial advisor to really understand, to be in a position to advise the client correctly. First, let us not weigh all of them in the same basket. DHFL and SL, for all practical purposes, have yet not defaulted, right? Let's not call it the same case like IL&FS is. Second, of course, everybody knows there is liquidity problem, right? So what are these groups doing to make sure that liquidity is instilled so that the businesses can run? So I read a report where IL&FS has broken down all the entities into 3, green, amber and red. The red is expected to have a debt of some 15,000 crore rupees, which as of today, they are not in a position to pay back. IL&FS had put up some 20,000 crore worth of their infrastructure assets to the market to be sold, by the way, which they are expecting to generate some liquidity. What has DHFL done? 3 things. First, DHFL is not issuing new loans. If you see quarter on quarter, there is a 95% fall in the loans that they've been issuing, right? Second, what they're trying to do is get off some other businesses. They are off mutual funds, getting off insurance. They also sold stake in other housing finance. The third thing that they are doing is trying to securitize the debt that they already have, raise money, and then pay back the loans. DHFL has time and again made out statements saying that all the monies that I'm receiving, which is 2,000 crore rupees of monthly income, plus all the other monies that I'm receiving from everything else that I'm doing, I'm not going to give out more disbursements, but I'm going to use that to pay back my loans. What is Zee doing? All of us are aware that there are talks where it is quoted that Zee is ideally trying to sell some stake to create liquidity to either Comcast, Sony, Apple, Reliance, there are various names put out. All I'm trying to say is 2 things. First, let's not put DHFL and SL as of today that I stand and talk to you with IL&FS because they have not defaulted. This is what they are doing to raise liquidity. Third, most important thing is somewhere all of us have really lost our faith on credit rating agencies for whatever has been happening. I was just going through some data and I thought it will be very, very apt for this particular audience. So I picked up some data from 2007 to 2017. Of course, the only reason it is 2007 to 17 because that data was available on the public platform, right? It says that CRISIL, which has rated AAA to companies, and it is a cumulative rating and not a standalone rating, has seen a probability of 0 default over 1 year, 2 year and 3 year. Even to a AA rated paper, CRISIL has seen only 0.02% default, and in an A rated paper, CRISIL has seen a 0.22% default in a 1 year paper, right? Yes, we are not confident now. We might talk that credit rating agencies are probably not the kind of people that we want to believe, but what we see of IL&FS may only be a one standalone case, and let's not categorize that as market risk, right? Fourth, most important thing. Everybody sitting here in the audience feels that when a debt defaults, which means we've lost all our monies. Unlike a bank, where if you default and go back to the bank gives you an opportunity to restructure and do stuff. That doesn't happen in the mutual fund space, is because as soon as the payment is not paid, you will have to downgrade, mark down the debt. Now, while marking down the debt, you might see a 25, 50, 75, 100% loss, but is that loss permanent? Let me give you some stats. There are 3 major, very recent default stories that all of us have heard of. MTech, Built, and JSPL. Has all the money been lost? In MTech Auto, 85% of the debt is already recovered, which means it was 100 rupees that MTech was expected to pay back, 85 is recovered. In Built, out of 100 rupees that Built was supposed to pay back, 83 is recovered and still counting. For all practical purposes, for JSPL, we will say that 67.5 or 75% is recovered because that is what the price at which the scheme sold to the AMC, but JSPL has not defaulted. So theoretically, the entire 100% is recovered. What I'm trying to tell you is, imagine a fund which has 100 rupees of AUM. You've invested 2% in a particular debt which is defaulting, which means you will have a 2% loss if the default happens, but that 2% loss is at that point in time. Imagine 3 years later, if the recovery rate is 80%, which means of the 2% loss, 1.6 would have been recovered. So the net loss to the scheme is 0.4, even if there is a default that happens. Just for your understanding, the mutual fund industry has only experienced a 0.4% NPA. Something to go back and think about, right? Let me show you the same examples with the schemes. This is where the MTech default happened. Had clients held on, the red line that you see is a straight linear line, right? Continuously moving up. This is exactly the case that happened in Built. Yes, there was a small nudge there where the default happened, but look at it post that. It's a straight linear line upwards. JSPL, once that nudge is taken care of, it's a straight linear line up. All I'm trying to tell you is, yes, it might look a little difficult while the default happens, but if we are able to advise, empower, engage clients and get them to stay invested, that situation probably 3 years later is very different of what you and me think today is. What should you do if you already have clients invested and they probably are feeling the pinch? Suppose if the client is expected to redeem the money for a particular goal over the next 3 to 6 months, there are very bleak chances that the money will be recovered and hence you can get them to exit right now. But if at all the client can stay 2 to 3 years invested in the fund, please hold on. What you saw of MTech, JSPL, Built that we spoke of, probably the same story might turn out, and over time, the graph after the blip will only move linearly upwards. I have 1 minute and I'm going to be quick with this. Everybody today, I've been observing since the start, has been talking about why invest in debt. I think to a greater extent, there are 4 challenges that as IFAs we face. The first one is, while we are trying to say that I want to acquire new clients, second is I'm saying that once I've acquired, I want him to stay with me for a longer time. Third is I'm saying I want a higher pocket share of his investments. And fourth is where I'm saying that while I'm doing all of these things, I also want to end up making money. I think debt is a brilliant answer to all of these 4 questions. Why? So we are saying client acquisition first time. I think probably if there is somebody who's intending to come and experience mutual fund, I think, of course, equity is where we really want to be. But if we don't want him to experience a bumpy ride, there is no better proposition for him to experience, which is debt. Asset allocation, we talk about goal-based, we talk about risk profile-based. While an FD investor comes here, probably I think debt is a far superior opportunity to be offered than an equity fund. Predictability, we are saying probably if you forget about these 2-3 cases that have happened over the last 3-4 years, right? The returns, profitability, risk is far more predictable than in equity. The last thing, does it make business sense? Some data very quickly. So first, what is the average retail ticket size in equity? As of 31st Jan, it is 1.3 lakhs. What's the average ticket size in debt? 3.6 lakhs, which is almost 3 times. Now, once you get the client to be invested, how long does it stay? Data says 29% people only stay the course in equity beyond 2 years. That number is 23% in debt. There is hardly any difference. Third most important, with the gap bridging between what equity commissions were in the past versus now, debt is still there, equity has come down. Now that the gap has come down so drastically, but the ticket size is 3 times larger, I think it definitely makes a lot of business sense. Yeah? Thank you so much.